Okay, welcome everybody to our first workshop for the year, which is going to be about understanding your credit score and building credit. This is sponsored by the Gulf Winds Cares Foundation, along with the University of West Florida May Garden Center for Financial Literacy that's located right here on campus. So this is all about your credit score. And your credit score, folks, you may not believe it, but your credit score is an extremely important metric in your life. It is a composite rating, and we'll get into what it's based on in a few minutes, but it is extremely important and allows lenders to decide what kind of a risk you might be if they decide to extend credit to you. Whether it's credit cards, your mortgage, automobile loans, student loans, whatever that might be. And we're going to learn about two primary different types of credit scores. They're very, very similar in most respects, so it's not really important that you know that much of the difference about them. But it's very important to understand what your credit score is, how you can find out what your credit score is, how you can access your credit report for free, and we're going to learn all that tonight. Okay, it helps creditors determine whether or not to give you credit and what terms they may give you, what interest rate. That's the key point. If you have a lower credit score, they're either going to possibly decline you or you're going to pay a higher rate of interest than you would otherwise if you had a better credit score. Also, if a married couple applies for a loan, they will look at both credit scores of both individuals. And I actually learned in preparing for this that it's better that the spouse with a higher credit score apply for the loan in his or her name only and leave the spouse off than it is to have both when one of them brings them down, because typically they either go with the lower of the two or they average them together and use a blend of the two. So be careful, make sure. If you're dating somebody, make sure you get a credit report on them. Now look at this. This is very important. If you have a high credit score, and we'll learn what that is in a moment, it will make it easier for you to get a loan, to rent an apartment. It will also make your insurance cost lower. Now, that's kind of weird that what you're going to pay for an auto insurance, or if you have an apartment renter's insurance, it's going to be more if you have a lower credit score. But that is true. And also, to secure employment. There are some jobs, now not all, but some jobs where if they can say there's a relationship between your credit score, for example, if you're going to handle money in your job, then the employer would probably say, well, they're going to be handling money and their credit score is very low, so they're in some financial distress. Therefore, they may very well be more inclined than someone with a higher credit score to commit some kind of fraud, steal the money. So your credit score can affect all facets of your life. Very important. All right, your credit report. Now, we talked about your credit score. We're going to get into it in more detail. Your credit report is a comprehensive document that contains an awful lot of information about you. Historical information, and we're going to go through that. And they started creating they started accumulating this information on you from a very early age, the first time you applied for a credit card or any other kind of loan. So look at the kind of information that is contained in your credit report. It is a brief history about you. It lists your Social Security number in order to make sure they're associating your historical record with the right individual. It includes your employment history. It includes any and all addresses that they have a record of that you have ever lived at. It includes employment information, what employers you have worked at. It includes when and which specific creditors actually inquired about you. Because think of it this way. They want to know before they extend you credit if you're also talking to some Maybe you're trying to get student loans, and you're also trying to get a home loan, and you've also applied for a car loan at a dealership. Well, they want to know all that. And all of that will show up in real time as soon as it is pulled. That's called a hard inquiry. Now, when you inquire about accessing your credit report, that's called a soft inquiry. That does not affect you. It will not hit you. It will not lower your score. It's not a negative against you, but hard inquiries are against you. I was talking to somebody earlier. I refinanced my mortgage in March of 2020, and I don't know why, but the mortgage company and somebody else that they dealt with accessed my credit report. So I had 2 hits in the last 2 years, and they say they fall off after 24 months. So I guess going into April, whatever ding my credit score has as a result of that will disappear, and my credit score will automatically increase. I don't know. You want to be careful about making a hard inquiry because those do count against you. It includes the addresses at which you have lived, where you currently live, whether or not you have been sued, whether or not you have declared bankruptcy. Have any of your accounts been charged off? In other words, you told the creditor, I simply can't pay, and they decided it was a CDU loan. They can't find the CDU, it's $1,200, and they just say, we give up. But that's a permanent, well, not permanent. That will be a record on your credit report probably for 7 years. Okay, bankruptcies last for 10 years, but most other information lasts for 7 years. So that'll be seen by anybody who tries to access your credit report. Credit reporting agencies collect and maintain the information that's contained in your report. Now you're going to learn that you are responsible for monitoring and making sure that it's right. And there's a way we can do that. We're going to talk about that as well. But there are 3 reporting agencies, and they accumulate this information independent of each other. Okay? Some of them will have things that others that do not. Each maintains its own records. It may not have information relating to all of your financial accounts, which it may be to your advantage. For example, when you get one of the credit reports and you see your mortgage is not showing up, and you've had that mortgage for 2 or 3 years and you paid as agreed, and you're like, I want you to include that. You contact them and tell them, hey, I got this mortgage with this company, and here's the account number. I'd like it to show up on my credit report. And they will add it to your credit. You're going to have to prove it, but they will add it to your report. You say, who are these credit reporting agencies? The big 3 are Equifax, Experian, and TransUnion. And those are the web addresses that you can go to and check each one of them out. I don't know if any of you have noticed, it's Experian.com that is touting Boost. But you have to pay for that, I think. But what they're saying is if you will report them information about your cable bill, your streaming services, your telephone, your cell phone, they will add that. That typically is not, because that's a bill, not really a loan. That's a bill that you pay each month. But that's why they're calling it Boost, because it will boost your credit score if you are paying it as you're supposed to and have been for some time. It is your responsibility to check your credit reports regularly to ensure their accuracy. I suggest that you do that at least a couple of times a year, because particularly if you've gotten a new loan, particularly if you paid off something, and you want to check it to make sure nobody else has stolen your identity and is starting to take out loans in your name. The sooner you find something out like that and start working on it, the better. So that's important. You're entitled to 1 free credit report from each of the 3 major credit reporting agencies. So I say if you get 1 every 4 months, during a year you will get 3, and you'll get 1 from Experian, 1 from Equifax, and 1 from TransUnion. So in a year you have seen them 3 times, and so you're frequently checking on it. But you only have to they only have to give you free access once a year, each one. And you can go to annualcreditreport.com, or you can call that 1-877 number to request that information. By the way, does anybody have any of the apps on their phone that deal with, like, what do you have? Credit Karma, so do I. Credit Karma, and they tell me, I mean, but it's weird. It's really weird. For example, I was telling somebody earlier today, Credit Karma checks my credit card balance the 17th of every month. And so, as we'll learn in a few minutes, the more you have in your credit card balance compared to your total overall availability. So if I have a $10,000 balance and I owe $3,000, that's 30%. They say, Greg, you're pushing it. And so they may ding me and take some points away from me. So I decided I was going to get smart. And so what I did is I said, okay, I'm going to pay it off on the 17th or the 16th, a day or two before, just to make sure. It went down further, and they said, you don't have credit card borrowings. So I'm like, y'all don't make any sense at all to me. Your credit score is calculated using information from your credit report, and it is based, generally speaking, on the following factors, and there is a handout. Gulf Winds has a handout outside on this. So let's look. Here are these factors. Payment history, whether or not you have paid on time and as agreed. Okay? That's typically the biggest indicator right there. That's the big one. Okay? You better make sure you pay as agreed. You agreed to it. Your credit card utilization. In other words, try to keep, if your total credit line is $1,000, try not to go over $300 as your balance, because they're going to say you're over 30%, you're extending yourself, and you're getting out of hand. So that's their 30%. They'll tell you try to stay below that. Any derogatory remarks, or have any accounts been closed because, or, did you default on any loan? Did they do a charge? Did the bank have to do a charge off because you couldn't pay the CDU loan for $1,200? And so that's a derogatory remark that's going to be on your credit report. You don't want derogatory remarks. The age of credit history. So the longer you have a relationship, I was just talking to my aunt recently, and she said, and I didn't think about this. She said in 1979, she went to a bank that had just opened in her part of Atlanta, and she said back then, women didn't get credit cards. And she had just gone through a divorce, and she wanted a credit card in her name. And she went in and applied, and it was a female branch manager. And she said, I love that bank. I love that credit card. I don't want to give that credit card up because it has sentimental value to her. So she's had that since 1979. That's an awfully long time to have a relationship. But look, they're going to look at the average age of your credit. So when I refinance my mortgage, if I'd had the mortgage for a couple of years, then when I start over, okay, now's a new credit, and it's zero age. So I have lowered the average age of my credit relationships. So that's going to ding me for a while until I establish a good payment history on this new loan. The total accounts, and this is weird to me, they don't want you to have just a mortgage loan or just a car loan or just a student loan. They want you to demonstrate that you have the ability to handle credit card debt, a car loan, a home loan, student loans. So they want you to demonstrate that you have the ability to make regular payments on debt of a fixed amount, and they want to demonstrate that you're able to use a credit card judiciously and not drive it way up and just pay the minimum balance forever and a day. So that makes sense to me that they're saying they want you to use a variety of types of credit relationships. Hard inquiries. As I said earlier, if you've applied for credit, that's a hard inquiry, and that's going to hurt for a while. It fades over time. Credit Karma tells me that in 24 months, the hard inquiries for my mortgage will go away. I mean, they still, if I go in and look and it says, why did your credit score change? I click on it, and one of the things is hard inquiries, and it's been 2 forever. And you click on that, and then it says March of 2020, and this will go away in 24 months. So I'm counting the days, so that goes away. Also, be judicious when it comes to new credit. You might say, well, if I go out in 1 month and get a new car loan and buy a new house and also get a new credit card, that should make other creditors convinced that I'm a really good person. No, it makes them convinced you've gone hog wild and you are not to be trusted. We are not to lend you money because you're crazy. You've gone off the deep end. So be careful about new credits. Don't go out and create a credit card, apply for a credit card just because you want one, just because you want to start your credit score. No. If you need one for traveling for business or for whatever reason you might have a legitimate need, okay. But don't go out and buy a car loan or get a car loan just because you think it'll help your credit score. That doesn't make sense. It's like buying when things are on sale and thinking how much you saved. Okay. We have the Financial Literacy Center here on campus. So I decided to intersperse some financial literacy IQ questions in here. So I'm going to make you raise your hand for your answer. So let's see what the first question is. For a comfortable retirement, financial advisors typically advise clients that they should generate from all sources what percentage of their pre-retirement income in retirement? 30%? I've got some A, B, C, and D, so this will give you a 25% chance of getting it right? 100%. Well, that would probably be good, wouldn't it? 70 to 80%, 20%, or 0%. Social Security will be enough. The answer is, what is it? 70 to 80%. Okay? Now, rules of thumb, and which is one of them, they're not applicable to everybody. For example, it is true when you quit working, you're probably going to quit buying clothing, dress clothing that you may have to wear on your job. So maybe you don't have the dry cleaning bill. Maybe you have paid for your home by now, and so your mortgage goes away, so that's a big savings to you. I just finished reading a book, and this guy says he thinks most people can survive very comfortably on 50 to 60% of their pre-retirement income. And he's an actuary, which means he studies numbers all the time for insurance companies. And he's got all kind of data from the United States and from Canada in which he says if you look at, he has categories of spending, like what people spend on basic existing, paying their mortgage and that kind of thing, for their children. And he has these bar graphs, and he shows that as somebody gets closer to retirement, their bar graph changes. And he shows that if you paid off your home and your children they're independent and out of your home, then those are the two biggest expenses. So he says most people can survive with 50 to 60%. Now he does say this, single people, you've always spent the money on yourself. You never had to worry about putting children in school or anything. And maybe if you rented, you never had a home, so you didn't have to worry about that, and you're going to have that rent payment for the rest of your life. He says, in that case, people who've always been single probably need 70 to 80% because they're so used to spending on themselves that otherwise they're going to feel deprived when they go into retirement. So the answer to this question is 70 to 80%. All right. The two main credit scores are FICO and Vantage Score. Vantage Score is the one that Credit Karma reports. FICO is the Fair Isaac Corporation. They designed this years ago. Okay? It is used extensively and primarily in the mortgage industry and the lending. So when people say, what's your FICO score? They're saying, what is your specific credit score per FICO? All right. The scores range from 300 to 850. So you can see from 300 to 579, you're just poor. From 580 to 669, you're fair. And you finally get up to good at 670 to 739. Then you get very good. And the numbers are what percentage of people have them at the time that I got this information. So this is pretty encouraging, 20 and 25, 45% are either very good or excellent at this point. And if you add the 21, you're up to what, 66% are either good to excellent. So if you're in the 16 to 18, or maybe at the low end of the good, you probably got some work to do to fix this. The Vantage score was developed by the 3 credit reporting agencies. They said to FICO, look, we got all this information. We don't have to pay you to access. We can develop our own algorithm and figure out what somebody's credit score is. So there are 2 distinct credit scores out there, the FICO and the Vantage score, created by the 3 credit reporting agencies. It is based on similar factors as the FICO. But look at this one. This one is very poor, is their lowest range. Poor, fair, good, and excellent. So anything over 781, 780 and above is going to be considered excellent. So if you ever hit 800, 815, 850 is the top. And it's very hard to get there. Test your financial literacy IQ. If financial advisors tell us that we need to plan to generate about 70 to 80% of our pre-retirement income, how much of that can we depend on to be contributed by Social Security? Well, it is true. I think that in, is it 2028, I think, the Social Security Trust Fund is expected to start bringing in less than what it's paying out. Right now it's generating more, but now because of COVID, there's been this enormous wave of people retiring. So as those baby boomers decide to retire at 60, 61, 62 instead of working till 67 or 68, they're no longer contributing to Social Security, and they're starting to draw. So it has gone from, it used to be 2037 was the projected year in which Social Security, which what they kept calling go bankrupt. They're not going bankrupt. They would be able to fund only about 80% of benefits. Well, now it's moved all the way up to the late 20s. So it's moved up several years over the last several years. And you'll notice this is not something that any political party or any politician wants to talk about. Here are the choices. On average, about 60%. On average, about 10%. On average, about 30 to 35%. Or on average, about 85%. The answer is on average 30 to 35%. In fact, when I read about this in the book that I was reading, I decided to go to Social Security, ssa.gov, and look at mine and project out to when I'm going to be that age, and it works out to 31.5% for me. So I was pleasantly surprised. Now, for lower income people, it will be higher. It may be 35 to 38, 39%. For higher income people, it's going to be a lower percentage. It's designed to be a sustenance. I mean, it's trying to provide a minimum level of funding to people in their retirement. It's not designed to be the only retirement funding that you have. But now think about this. If you need 50 to 60%, let's just say 55%. Based on the book that I read, if you need 55% of your pre-tax, your pre-retirement income to support yourself, keep the same standard of living in retirement. And if you can depend on 30% to come from Social Security, then 55 minus 30%, you're down to what, 25% that you need to fund, okay? Now you say, well, then that's pretty easy. I can stop saving. No. Because do you know how much financial advisors say, if you've got $1 million retirement fund, how much do they say you can save? What percentage do they recommend that you can safely withdraw and have about a 30-year retirement? So that you start drawing at 65, then you can pretty much rest assured that you're going to make it till 90. You'll have money till 95. What percentage of that $1 million do you think you could safely take out in year one? 4%. So if you've got $1 million, that's $40,000. I would think if I got $1 million, I'm filthy rich. You know, I'm going to buy the Taj Mahal or something. But they're saying in order for you to be safe and be able to sustain market volatility throughout the years, you should start at 4% and you can adjust it for inflation each year thereafter. So if you got 2% inflation, 2% of $40,800, next year you can take out $40,800. Okay? So my point is, it's going to take a pretty big nest egg. For example, suppose you're making $80,000 and when you retire and you need $48,000 to come from, then think about how much that big of a pot of gold will generate for you safely in retirement. So I'd always prefer to have more money than I actually need, as opposed to run out of money and still got some life in me, okay? So I'd save more. Always save more, you'll never be sorry. How to improve your credit score? Well, what do you think? All those factors that we talked about earlier, pay your debts on time. Well, you should pay your debts on time. You should not go about getting new credits willy-nilly. It should be rational while you're going about doing it. It should be legit. You should use a variety of credit facilities. Pay attention to the factors that impact. Make on-time payments. Keep your credit card utilization to a reasonable level. 30%, remember, was what the credit card companies have decided is a reasonable level. Do not allow accounts to become past due. Try to maintain accounts over time. And even if you've paid a loan off, do not contact the credit bureau, the credit reporting agencies and say, please remove that credit. You want that credit to continue to show up because it gives you, maybe you started that loan 10 years ago. You do not want a 10-year relationship to suddenly leave your credit report, because that may harm the average length of your credit relationships. So leave it there. It's not going to hurt anything that it shows that you got the loan in 2005 and you paid it off in 2015 and you were never past due. That's a good fact. You want to leave that there forever. And of course, the longer you exist, the longer your credit report is going to become. It's going to be pages and pages more. Try to use a variety of accounts. Don't just use credit cards. Pay attention to loans, like home loans, car loans and type. And hard inquiries. Let's suppose that you are looking for an automobile, new or used, and you've got 2 or 3 in mind, okay? When you go to a dealership and look at a car, do not decide on the first car and do not give them information that they can access your credit score right then, because you may go to the next dealership and find a car you like even better at a better price, And now when they check your credit score, it's going to be deemed because they tested it. So what you need to do is wait and decide on the automobile that you want to get, and then have one hard inquiry against your credit score. That make sense? Suppose you're just getting started. You're a college student. I think we got some college students in here. Maybe you've never had a credit relationship, or maybe a small credit card. You can get what is called a secured credit card. So you say, I'm going to put $500 in an account, savings account or some kind of account, and you give me a credit card with a $500 limit. So they pretty much are sure they're going to get their money because, boom, they got the money in that account. And I guess the account will not be accessible by you, so it's going to stay there. So that's a secured. You can do a secured credit card, okay? So that's an option. Get a cosigner. A lot of parents do this for their child when they first go off to college because they want them to have a credit card. Now the problem with that is the cosigner, I mean, if that kid goes crazy and runs up $10,000 in pizza, Papa John's pizza, then mom and dad are on the line for that. So I would, if I were a parent, I would try to make sure that's a very low, reasonable amount and not something that gets out of hand. Use a mix of credit relationships if appropriate. Don't go out and buy a car just because you want a different type of credit facility on your credit report. Make all your loan payments and credit card payments on time. And then there's one more here. Become an authorized user on someone else's account. Say I have a credit card and I have a son who's going off to college, and I say, okay, he can sign, he can use this credit card and spend money on it just like I can. It's not in his name, it's in my name, but if he's an authorized user on the card, that can be reported and can help your credit score over time. That might be a better thing, but then I don't think I would want the kid on my $10,000 or $15,000 credit limit. I'd want it $1,000 credit limit. I got another IQ question for you. For a comfortable retirement, Fidelity recommends clients hit the following savings targets. Now listen to this. So this, you can't say, you got to have $1 million before you can retire. Well, look, if I'm making $40,000 a year and I've got $1 million, I can draw $40,000 a year, so I'm getting 100% of my pre-retirement income in retirement. So I probably don't need $1 million. So Fidelity developed this rule of thumb for every age, 30, 40, 50, 60, and retirement at 67. Okay? What do you think they say you need to have saved by the time you reach the age of 30? Not in an amount, in relation to your salary. 1 times your annual salary. This is very important. If you have children, teach them. When you have children, teach them. If you're still quite young, use this. Time value of money is on your side when you are young. So, years ago, I read in Money Magazine an article, this was probably 40 years ago, or pretty close to 40 years ago. And it was about, they gave a scenario of 2 brothers, twins. They were 20 years old. One of them starts putting $2,000 a year in an IRA because that was the maximum amount. And he earned 9% a year. This was back probably in the 80s. 9% a year. And when he reached 30, he had $30,000. He got married, started having children, couldn't afford to contribute any more money to his retirement. His brother, on the other hand, throughout his 20s, he spent all his money. He didn't save a dime. He bought expensive cars, clothes, everything. When he got to be 30, he said, my brother's already got all this money, and I don't have anything. So he started contributing $2,000 a year from the age of 30 to the age of 65. Who will have more money when they reach the age of 65? The first brother. Because, look at it this way, 30,000 times 9% is $2,700. The second guy is going to contribute 2,000. So the first guy is earning 2,700 without contributing anything. He's already built up his balance so high that it takes on a life of its own. And let me tell you, I taught over at South Alabama, and I taught the capstone class in accounting over there, and I would say, look, folks, you're about to get out and get your first real job. And they were going to be making pretty good bit of money compared to working part-time at the mall or working at the car wash or whatever. So I said, look, I know that you have a lot of pent-up demand, but let me tell you this. When you go to work with your company, your employer, whoever it is, number one, when you interview, you make sure you get a 401k. And you make sure that it is a good 401k program. And when you start, you contribute the maximum amount or whatever amount you have to contribute in order to get the company match. If they say, we will give you 50% of everything you do up to 6%, then you put 6% in and they put in 3%, so you're at 9%. Okay? In the early years, you're probably getting promotions, and so your payment may be going up by 10% or 15% every 2 or 3 years as you get promotions, as you pass the CPA exam, as you become a senior accountant, and that kind of thing. I said, up your contribution by 1% every year. So you say this, and you don't know if it's having any effect. One of my former students, a few years after he was in my class, sent me an email one day when I was still over at South Alabama, and he said, remember that day when you talked about this, the twins? And I was like, yeah. And he said, I left work that day, I left school that day and said, I'm going to have 30,000 by the time I'm 30. I want to be that first guy. He said, I wound up having nearly 48,000 by the time he reached 30. And he said, and I turned my sister on to it too. She's younger than him. And now I've become friends or acquaintances with his sister. And periodically, when she hits milestones, she will text me the screenshot of her Merrill Lynch account. She recently, now she's 32, I think 32 years old, be 33 in November, probably has never made $50,000. She texted me the other day, her snapshot. How much do you think she had in her account? Huh? $107,000. And I want to tell, I've talked to her and said, look, keep doing it. Don't stop. Keep going, because you can quit when you're 50. And you'll live better than you've ever lived in your life. But you got, she majored in something that didn't have anything to do with time value of money. She never took a class in the College of Business. So she had no understanding of time value of money. But I said, think about it. When you get $100,000, if you earn 10%, that's another $10,000. And in any of these years that you've contributed, you haven't contributed anywhere near $10,000. And so eventually that will take on a life of its own and grow out of control, so that she is, boy, she's on fire. She's got more money. Well, she had more money when she reached 30 than he had when he reached 30. So now it's a competition between siblings. And in fact, they have another sibling who's married with several children, and they like to rub it in his face, and he got mad and told him to quit discussing it, because, he didn't like, I got 3 children and a wonderful wife, so, yeah. And all you got, money's not going to keep you happy all your life. But they're like, well, I'd rather have money than I have be alone, not have money. So she told me, and I shared this with her when I saw this, and she said, okay, I'm working on that one. Well, if she makes $50,000, and she doesn't, but if she makes $50,000 by the time she's 40, she will need $150,000. She's already got $107,000. and she's 32 or 33 at the most. She's got a long time to get to 40. So my point is, because she sacrificed, and the guy told me, the brother told me, he was dating a girl who was an HR director. Get this. She did not contribute to her 401k. And he said, why do you not contribute? She said, I might get hit by a bus. And he said, well, you better hope you get hit by a bus. Because I'm not going, I ain't going to be supporting you. What do you think it is by the time you're 50? 6? 60? 8? And by the time you get to full retirement age, 10. Now I'll tell you folks, if you have 10 times your annual salary when you reach 67 in savings, you will live a really nice retirement. You'll be really comfortable. I mean, that plus your Social Security, plus whatever you've saved. I mean, you know, whatever you save, like your house that's going to be paid for and all that kind of stuff. That's the key. Get debts paid for so that you don't have that home mortgage for the rest of your life. So that's these, and so this can be used whether you make $30,000 a year or $40,000 a year or $100,000 a year. You can use this yardstick to see how you're doing. And Fidelity is one of the big mutual fund companies. And so, they've got thousands and thousands and thousands of clients. And so they have developed this yardstick based on their information. So my question to you is, are you on track for a comfortable retirement? The May Garden Center, our overriding objective is to improve the financial health and well-being of all persons residing in the University of West Florida service area. We achieve this objective by two things: offering credit counseling services by certified credit counselors. We have, at last count, eight certified credit counselors. We have PhDs, we have CPAs, and then we have normal people who do it. So we have a complete gamut of folks who volunteer their time. That's what I want to talk about next. That are available, and it's free. You don't pay for it. Students can come to us and do come to us regularly to ask for. Mr. Eanes and I met with a student probably a year ago now or so, and she'd already been to the Financial Literacy Center before and been counseled by one of our graduate students, and she said, I want to know about my credit score. What's that all about? I keep hearing about credit score and I don't know anything about it. So I should have emailed her and told her, if she's still here, to come to this tonight. So she wanted to know about her credit score, and we were both really impressed with her determination to succeed and her plan for spending money and stuff. And we also offer these kinds of workshops, seminars, speaker series. And you can also, if you want to contact the Financial Literacy Center in order to make an appointment or ask them about, we have information. We have plenty of brochures. He's got brochures outside, and we've got more brochures in the office. So if you say, well, I'm interested in this, student loans or something like that, then let us know, and we'll tell you if we got something, and we'll set up a time to meet with you, or we'll Zoom with you if you don't feel comfortable coming in. And it's financialliteracy@uwf.edu, or you can write down that telephone number, and I'm assuming that's the number that would ring on your desk. And I think that is it. Thank you very much, everybody, for coming. We appreciate you, and we hope to see you back in March.